I think that means we're live. This is Value After Hours. I'm Tobias Carlisle, joined as always by my co-host Jake Taylor. Our special guest today is Todd Wenning, KNA Capital, Flyover Stocks. How are you, Todd?
Doing great. Thanks for having me.
Pleasure. Tell us a little bit about KNA Flyover Stocks. What's your focus there? What's your philosophy?
Flyover Stocks is a blog that I started in fall of 2023. When I was at Morningstar, I did a series called Seeking Small Cap Moats that proved pretty popular, and I kept getting emails about it for years after I had left Morningstar. And so I figured when I started a Substack, I was going to focus on around the same thing. So Flyover Stocks is focused on companies that I think are quality, that are worth looking into, that may not have a lot of analyst coverage, that I find particularly interesting, that may have an economic moat led by good managers. So that's the context of Flyover Stocks. KNA Capital is my Ohio registered RIA, where I help people manage money, and I have a equity strategy called the core equity strategy that I use to employ my investment philosophy. So it's a lot going on, but I'm enjoying it all.
Do they have to be Midwest-based companies for to qualify as flyover?
Some are in like the Southwest. I have some UK companies as well, but generally speaking, they're names that people don't know very well.
And then how about teaching that you do? I know at Dayton.
Yeah, so on top of Flyover Stocks and KNA Capital, I'm also a lecturer at the University of Dayton where I teach finance. I teach, right now I'm teaching Intro to Finance, and I also teach a class called Applications of Sustainable Investing, which integrates some ESG things, but also thinking about economic moats and what makes companies durable and sustainable. So I try to bring in sort of the Buffett approach, thinking about moats and great management teams and how they all integrate together. So it's I'm staying pretty busy these days, but the semester is wrapping up soon, and I'll have a little break here. So that's one perk of teaching university classes is that you have some extended breaks along the way.
Let's talk about small cap moats. How do you find, asking for a friend, how do you find small cap moats?
Yeah, so small cap moats, there's a lot of similarities with large cap moats. It's thinking through sort of the five frameworks that Morningstar had taught me, which are switching costs, network effects, low cost production, intangible assets, and efficient scale. So trying to put the companies in one of those five buckets or more. Some companies have switching costs and network effects, for example, and those are really the gold mines where you can find two moat sources, which makes them really difficult to compete with. And really, when you find these small companies, what differs them from the larger companies is maybe growth runway. They may not have a huge addressable market, but they have a nice niche market. They can generate strong returns on invested capital. So I'm looking for all the same factors that I do with large cap companies, which are high returns on invested capital, predictable free cash flow, predictable revenue growth, all the things I'm looking for in the large cap. There are also some in the small cap world. Now, sometimes the big difference might be sort of the quality of the management teams. So I do a lot of work looking into those as well, trying to figure out if they are smart capital allocators or if they're perhaps not to snuff in terms of their ability to grow the business long term.
Does that tend to be where thesis breaks down is it's a decent little niche business and it's earning, but then the cash is kind of being squandered potentially by bad cap allocation?
Yeah, that's a common theme that I see, and it can also be one that just puts me off on the company. Now, there are companies that are real exceptions to that. They just have a really niche business, and management's happy to grow the business at a decent rate. But there's other companies where you run into small cap managers where they don't have a large ownership position, or maybe the financial incentives are misaligned, and they're just not, or perhaps not equipped strategically, thinking about how they can move their business into new markets. Perhaps they want to grow, but maybe they do it in the wrong way. Maybe they do an acquisition or they get acquired, and they're not really thinking about the small shareholders in those situations.
I'm sort of surprised that small cap moats still exist because it feels like if something has a moat, then it should be growing into mid or large cap world, should be passing through smalls. And anything that sort of lives in small cap world is a little bit like economically disadvantaged, which is why it's a small cap in the first place.
Mm.
What
How do you
do you have any?
reconcile that?
Yeah, any
Yeah, so
example?
Yeah, I think
Sorry, go.
no, okay. Thinking about going back to the Buffett analogy, the initial moat analogy, which is the moat is there to protect the castle, right? The economic castle. And that's supposed to be led by a virtuous knight who's looking to expand the castle. And the moat is really there just to protect the steward's ability to grow the castle. So the moat itself can be thought of as a separate issue from the growth runway or the size of the potential castle. It's just a structural moat that protects what's going on inside the castle. Now it's up to the management team to figure out, hey, how can we maximize this opportunity that we have? And what the moat does is just give those managers time. But you might have some businesses that have huge growth runways and huge reinvestment opportunities, and the castles can become very, very big. But there are also companies, like small companies, that maybe just have a niche. And it's a nice little castle, but it's not a huge gray castle that can become the next S&P 500 star, for example.
Do you have any examples of names that sort of small cap but moaty?
Sure. So one of the companies that we have in the K&A Capital portfolio is a UK company called Games Workshop. And if you're a hobbyist, if you've ever followed Games Workshop, you know the Warhammer 40,000 brand. And so they make tabletop caricature games that are pretty intense. It's the most similar comparison is Dungeons and Dragons. I know I might get fried by the passionate Warhammer group for saying that there's like Dungeons and Dragons, but it's a similar concept, and it's an opportunity to create these deep narratives. And Games Workshop they have a publishing arm, so they create all these stories and they release new editions and new characters. They have new scoring systems. It just keeps it really fresh and interesting, and so. They are growing very nicely. In fact, they have a upcoming series on Amazon that's going to be coming out that's led by Henry Cavill, the actor. He's apparently a huge Warhammer fan, and so they're going to be creating.
Superman plays Warhammer.
Yes, exactly. He's a big hobbyist and big Warhammer fan. So they're creating all this IP around its movies, and that's really taking it, I think, to another level, which is why it's currently in the portfolio. But it's such a niche business, and that's their focus. And if you read the annual letters, which are great, I highly recommend reading their annual letters. You'd think with all this IP and this sort of the fantasy world that they'd have these glossy annual reports with all these crazy characters, but
Written in ye old English.
Exactly. But it's just like a Word document. It's great. It reminds me a lot of Berkshire in that way. And the CEO, Kevin Roundtree, just speaks very plainly, talks about what their focus is, and their goal is to create the best games possible, best characters possible, and that's it. And that's their focus. And they want to continue doing that forever, right? That's what his phrase is. We're going to keep doing this forever. And so when I hear that phrase, that gets me interested. It's like, this is something that I'm thinking about long-term beyond my tenure. That tends to be a sign of a good steward of capital.
So what is the business? They own the Warhammer brand. It's not a retail location selling games.
Well, there are stores. I've seen them.
Yes. So they do have stores around the world. There's one in Cincinnati here where I live. There are most major cities. Most of them are run by a hobbyist. So they're single person stores, and they're open from like 12 to 8, 6 days a week. And
it's like Comic Book Man from The Simpsons.
Very similar. I remember my daughter and my son and I walked into one, and everyone's kind of turned and looked at us like, "Who's coming in?"
New blood.
New
you
blood.
Don't belong.
Yeah, right.
Strangers.
Yeah. I'm not one of you guys yet. But it's a very addictive habit. I've told people that I bought my first set of Warhammer characters, and it's really cool because there are these little plastic figures that you can snip out, and then you take the time to paint them. And so there's an IKEA effect, right? Where you're building and creating these characters, making them come alive, and they're yours. And then you can take them and play them against your friends, and you can have these really ornate landscapes where the games are happening. And a friend said, you're crazy for starting this because it's a really expensive habit.
Yeah.
Once you get, cause I think the starter kit was about $65 for, just the first set of aliens and humans, to fight each other. So it's an interesting business model. But they have retail shops, and they business through third parties. So if you just a general hobbyist gaming store, they may have the Warhammer games there as well.
Any sense of like how much, what's the annual spend on like the kind of power user?
Yeah, there's definitely a power law in effect here. I mean, there's sort of the super players where the top 10% spend. I mean, it would not surprise me if it's well into the five figures per year in terms of what the top decile of spenders do play on. Because there's been a risk of 3D printing for a long time. This
Mm,
idea that hey, we can just replicate these characters using 3D printers. That happens a little bit around the periphery. Maybe there's a really expensive character that someone just really wants to play with. But generally speaking, the hobbyists, I think, understand that if they don't give money to Games Workshop, what that's going to do is the whole world just sort of slowly fades. And
mm,
so because Games Workshop also is engaged with the publishing. They create the narratives in the world. So if you take them away, what are you really left with? And so there's this really good, strong, virtuous flywheel. I think that happens. That phrase gets thrown around a lot, but when people enjoy their games, they want to play with other people. It creates community, in-person community, which is increasingly rare today, right? And so I think generally speaking, people are seeking community, real physical community, and this is one way to do it. And anything that can do that today and be very profitable at it, that's a good place to be, I think.
have they done any video games?
They do license video games. So if you have a Switch, you can buy Warhammer games on there as well.
There is a big Warhammer franchise where there's Space Marines. Is that
Space Marines,
associated with
yeah,
it?
yeah, those are like the quote unquote human characters,
So that is part of that universe.
right?
Okay, that's kind of interesting. And what sort of revenues, market cap, profitability, margins? What's all that look like?
So it's very small, relatively speaking. Certainly in the Nvidia world, it's well short shy of that. It's a fairly small company, still fairly niche. I don't know what it is in pounds off the top of my head, but it does a nice steady business, high returns on invested capital, high returns on common equity. It's just a very very profitable little mid cap business.
And sorry, we're getting some notes. Switch PC 5,000 games with GW IP per year. What's GW?
Games Workshop.
Games Workshop IP
Yeah,
per year. Okay,
yeah.
interesting. And what's the upcoming? So there's a movie upcoming with Henry Cavill or a TV series upcoming with
Mhm.
Henry Cavill, and you expect that to expand the user base.
Right. I think it'll help people find the hobby, which
Yeah.
will then turn it into, hey, create new communities, and then just the flywheel starts and continues. So they've had very successful results. There was an expectation a couple of months ago that maybe they were going to have a tough comp coming into the second half of this year, and they just had a trading update saying, actually, it's going to be a little bit better. And there's the licensing revenue is 100% margin. So anything that they do with Amazon or whatever, whoever they license to, goes straight to profitability. So that's a really nice sort of option that they have in the business.
That's traded locally under ticker GAW.
Yes, and so you can buy the pink sheet or the
Okay.
OTC equivalent in the U.S. if you don't have access to the UK market. But as with any small cap trading overseas, if you're going to buy it, use a limit order. Make sure that you're you're getting the best price possible.
Does your portfolio look like those kind of positions? Do you hold MOTI positions or do you hold some more cyclical stuff? Or can a cyclical be MOTI?
Yes, I think cyclical could be Modi, and I think when they have downswings in their industry, that's a good time to pick them up because I think the modiest companies in a cyclical industry are the ones who are most durable and can continue to think longer term, while some of their competitors are freaking out, maybe trying to drop price, trying to get volume in through, cover those fixed costs while they can have a more long-term perspective. And I think one company in my portfolio that has been doing that, and I think will continue to be strong in their industry is Old Dominion Freight Lines, which is a less than truckload company that has networks and nodes across the US. I think they're the second largest LTL freight company in the US behind FedEx Freight,
What's
which is
LTL?
less than truckload. So there's two major types of trucking. There's truckload, which is what you might see driving on the highway, where they're taking one trailer from the shipper right to the end destination, so point A to point B. Whereas LTL is where you're, as a shipper, you rent or you buy a part of the trailer. So you might put a couple of pallets on a trailer at ODFL, and they'll take it to their local service center or their warehouse, where it'll be unpacked off the trailer, put on another trailer going to another destination with other products from other trailers. And so it can get broken up and shipped. So if you're shipping something from, say, Florida to Washington State, it might be on 3 or 4 different trucks that go along. So you're not just hiring one trailer to take you from Florida to Washington. It might be put on one truck, taken off, put on another one, so on and so forth. So having that operational efficiency, that really strong culture that Old Dominion Freight Line has, to make sure that they are on time and there's no damage to the materials. You can imagine how many opportunities you have to break something when you're taking things on and off a trailer 3 or 4 times. And Old Dominion has a 99% on time and less than 0.1% claims rate. So it's a very, very small breakage issue.
And so what's the moat that you need a network of these depots and trucks around the country to sort of make it work?
Right. So think about if you had $1 billion, let's say, to take on Old Dominion, it would be really hard to do that in a reasonable amount of time. First you have to build the service centers. You have to find the locations, and a lot of locations that ODFL has, they've had for decades. So they're in these population centers now. They've been built around. So if you're trying to do that today, you're going to have a NIMBY effect, where people don't want to have your service center right in the middle of their neighborhood. You got to go further and further out from the population center. So ODFL has been benefited from these long existing spaces where they're still in city centers and city approximates. And so you have to find the real estate that's attractively placed, and then you have to find local orders, right? You have to have salespeople who go out and try to get enough volume into your service center to cover those fixed costs. So it's a very difficult process to do. It takes a long time to do it. And the returns on invested capital are really nice, but they're not super attractive, where you might throw out all the stops to build these things, right? So if you come in and you're saturating the market and dropping prices, that's going to impact everybody's returns on invested capital, including your own. So there's a little bit of efficient scale moat that happens there as well. So what I chalk up their moat to is it's kind of like a physical network effect. They have these 250 or 260 nodes in their network across the country. So they can get things from California to Maine in 2 days, 1 day. And that's because they have these networks, these nodes in place across the country. And so as they add new nodes, they can serve more customers. The whole network becomes more and more valuable.
What's going on in trucking? Why is it an interesting entry point here?
If you look at the trucking numbers, it looks like we're in a massive economic recession. The truck rates are, or were at least, they've recovered a little bit, but they were kind of what you were seeing back in the financial crisis, just really bad numbers. And a lot of it had to do sort of this, there's still these COVID effects, post-COVID effects. So there was this idea that during COVID, there was a trucking shortage, right? And so rates went up, which brought in new drivers, some domestic drivers, some international drivers into the US market, which created an oversupply of drivers. So when the economy cooled a little bit, rates all came down. And it got to the point in some cases where it was more attractive from a cost perspective to get the whole trailer and take it from point A to point B than it would be to do an LTL shipment, because rates just went that far down. Now, one of the things that Old Dominion has that I forgot to mention was that they are preferred carriers to a lot of the largest retailers in the US. So if you are sending things to Walmart, you have to use one of their preferred carriers, right? There are situations where someone hires a non-preferred carrier, they have to stop the shipment midway and have a preferred carrier pick it up. So so that's another moat source, right? You can't just say, hey, I've got a truck, I'm going to deliver things to Walmart. You have to be on the preferred list. So this is one of the interesting things about these cyclicals, these industrial companies, which they're a lot more dynamic than they may seem at first glance.
Uh, I was sort of trying to understand because full disclosure, I have some ODFL in some of the funds that I manage, but I'm trying to understand the cyclicality of this industry a little bit because it's is it a result of COVID or is it like a tariff thing or what's driving this cycle, do you think?
So historically, there's been a couple of different factors at play. Tariffs definitely didn't help anything. ODFL used to be primarily industrial shipments. So you're thinking like someone shipping a couple lawnmower engines across the country, perhaps, or like a press or something heavy. And so that used to be the majority of their business. Now I think it's about 60-40 industrial retail. So the retail business just boomed. And so if consumer spending softens or if inventories have been replenished at the Walmarts and the Wegmans of the world, perhaps they don't need as much going through the LTL network as they have in the past. So if you're looking at a per service center basis, the volumes have come down quite considerably over the past couple of years, just because just the number of shipments has slowed. And that it's a very high fixed cost business. There's a lot of operating leverage. And so once the sort of activity in the network slows down, that pulls back the margins. But the good thing is as the density increases of the network, the downside to the margins goes down, right? And so we've seen that with ODFL, even though that the volumes have decreased across the network, they are not anywhere close to where they were, say, in the early 2010s. They've solidified at a higher rate than they were before.
And you say that you've seen an uptick recently. Why do you think there's an uptick and to what do you attribute the uptick?
Yeah, it's unclear. I mean, I think what's happening from what
There's been a recovery in the stocks, or there's been a recovery in the fundamentals.
right, yeah, right.
Shipping NVIDIA chips around, Toby.
Yeah, I think part of it is there's been some addressing of the supply issue. So some of the things I've been picking up are that there's been a crackdown on non-licensed, non-commercial licensed drivers to move things, right? You've seen some stories about accidents from people who weren't licensed to operate commercial vehicles. And I think there's been more of a crackdown on that side. And some of the immigration concerns, this is an apolitical statement, right? Just there's immigration concerns, and that has impacted the supply of drivers as well. And that has helped lift rates. And so that's helped. I think based on where the stock price is, the recovery that we're seeing, the market seems now to be looking past the short-term rate concerns and looking ahead to a brighter future, so to say. So the stock got pretty cheap, I think, a couple weeks ago, and it's recovered since then a little bit. But I think it's still an interesting company to own.
Because it's a little bit of I don't know if it's a stock market I saw or if it's something that somebody's like tested systematically, but there is this idea anyway that transport's sort of one of the highly cyclical, but very early stage. I tweeted this out yesterday about transports have sort of recovered and look like they're above some moving average or some prior point. And so as a result, there's some suggestion that that cyclical economy is starting to improve a little bit.
This is like a leading indicator. Is that what you're saying?
A leading question, did you say? Leading the witness. Objection, leading. What do you think? Are you seeing any sort of recovery outside of transport? Do you think it's or trucking? Do you think it's trucking specific?
Yeah, I have in the portfolio about 30% industrials right now, and I've seen them start to pick up across the board, which has been good to see. I also own Ferguson, which is a plumbing and water infrastructure company. They've had some nice tailwinds behind a lot of the data center, a lot of large projects being done. So all that bodes well, I think, for an upturn in the industrial economy here in the next couple of years, which would be really nice because it's been a pretty difficult place to be over the previous year to 18 months.
Yeah, I tweeted this one out too. I like to look at the leading economic indicators against the coincident economic indicators, and those two series together. When the leading drops well below the coincident, then it's suggesting that there's some weakness. And it's interesting to just take that ratio of leading to coincident, and it goes back sort of 30 years or something like that. And you can see there, or actually it goes back further than that, because there are three readings that are as low as the current reading. And the 1982 at the very bottom, 2009 at the very bottom, and today are all the same. And it's kind of a little
What
bit.
does that mean?
Well, there's a portion of this, the leading economic indicators that's sentiment based. And so it's University of Michigan, some sentiment indicators are in there. And they include, funnily enough, included in those leading indicators is the stock market, which is strong. So why that is giving a negative reading is basically it's all of this sentiment reading is very negative. And I don't know if that's a political, people generally upset politically, or if it's like an actual indication of how they're feeling. But it's such a strange reading. It's so far below anything else on that series that it looks to me like we're at the bottom of a recession rather than at the beginning of a recession. Like if anything, it looks like we're coming out the other side. And then I see stuff like transport's recovering, and there are a few other things that look like they're recovering. It's a very strange cycle. I mean, I don't know if that means that macro is totally unhelpful. I get that, but I'm interested in it because it has direct impact on some of the cyclicals that I hold. So I just wonder if anybody, folks at home, like let me know because I'm sort of interested in it. I haven't really got my head around it completely. The sentiment portion of that leading economic indicator survey, is that misleading, or is that telling us that we're at the bottom of an undisclosed recession, depression? Let me know. Guys,
Above my pay grade.
yeah, above mine too.
Yeah.
I'd love to figure it out. It's one of those things I've been looking at that, I think it looks to me like it started in 22, and there's just been this like straight line down since 22 to today, and it's whacked all of the cyclicals. And the only things that haven't been caught in that are things that are beneficiaries of the AI capex spend. And GDP is not caught in that because GDP has a big government spending component to it that just means that it's soaring well above all of those sort of cyclical indicators. It's not helpful at all, I realize, but it's sort of interesting.
Do you think there's anything in, like, Mike Green had a recent piece about, he was saying like kind of the cost of the ticket to be part of the economic game in the US has gotten a lot more expensive than it was in, like, let's say the 1960s. And a lot of that had to do with housing prices, childcare, and
Yeah.
medical expenses. And the math that he did came up with something like 130 to 140,000 per year is the equivalent of like the poverty line used to be,
Yeah.
whatever it was back in the 1960s. I've seen some other work since that kind of like cast some doubts on some of those numbers, but still kind of interesting.
I've not
So maybe it's that negative sentiment from like, if you're under that, you feel like you're at the poverty level.
I read his piece. I thought it was very good. I'm not qualified to comment on any of the numbers that he used or the process that he used, but I
It's a
didn't see it.
podcast, sir. You go ahead and do whatever.
But I'm just like, I've been looking at the responses too. Like, it doesn't seem to me that anybody's really addressed his numbers or his process. They've just sort of said, that's not how it's done. This is how it's done. But his whole piece was the way that it's done is wrong. Here's another way to think about it. And I haven't seen anybody kind of deal with his numbers. 140 feels heavy to me. That feels high for the poverty line, but
I think a lot depends on where you live.
True.
140,000 in the Midwest goes a lot further than 140,000 in LA.
That's a good point. That's a
So
very good point.
it's sort of like the national housing numbers as well. You hear about national housing. Well, what matters in housing is local, what's happening in the zip code. And there are some macro effects. There are some larger effects that are interesting. But I think when you're having these conversations, you need to think about what does that mean locally. And I think I read the piece and I thought, it was directionally correct, and it certainly tapped into a certain feeling or sentiment that a lot of people have. And I think that's why it's really taken off, is it's just kind of tapped into this anxiety that I think a lot of people have, thinking about AI, about, job security and things. And am I getting dealt a fair hand here? So I think, in terms of the commentary, putting numbers behind it, I don't know, like you're saying, I don't know how to substantiate that, whether that's the correct number or not, but it definitely tapped into something, some sort of spirit that's been, hasn't been perhaps discussed enough in society.
I mean, it's certainly turning up in sentiment numbers. It's not, I don't know how they're judging those sentiment numbers, so maybe I should just be quiet about it until I figure that out. But it does seem to me that, yeah, there's tapping into something that is being reflected over and over and over again. And I don't know that you can just say everybody you're wrong. Like that, I feel like they were saying that
Yeah.
in relation to the inflation. They were just saying, yes, everybody's wrong. The inflation numbers are right. And then you know, I don't think they are right.
But it's interesting. I mean, you do look at, so I've seen some other people post some things in response to it, and it's like, hey, look at travel spending's up, hotel spending's up, and
Yes.
so these are highly discretionary numbers. And is that really all coming from just the top 10%? Maybe it is. I just don't know. But these are all things that need to be dealt with. And it'd be great to get perspectives from all areas of the socioeconomic space and not just a bunch of hedge fund managers and
On
wealth managers
FinTwit.
like ourselves, right, talking about these things. So it'd be really nice to get a more 360-degree view of these issues, because I would personally love to hear from people who are going through it, who are really feeling those pressures, and understand deeper level what's going on.
I mean, you're right about that. I think the TSA was a record numbers for throughput in terms of numbers, like not in terms of spend, in terms of numbers. So that would be a more important measure. Like spend could be, tickets are more expensive than they were last year. So of course spend is up, even though it's the same number of people moving
Right.
through.
Unit
But it's
volume
not that.
versus price.
Yeah. And I think there is a lot of that in businesses that, numbers are up marginally, but unit volume is down a little bit for a few years now.
Yeah, and we're really seeing that the blowback for that in the consumer packaged goods space. They were pushing price for a number of years and making revenue look great, but the volumes weren't there, which suggests that
Yeah.
the relevance of the products was declining relative to the value they were creating. I love Jake's diagram that he had in his book with cost, price, and value. And the idea that these consumer packaged goods companies are pushing price up closer to the value proposition, and so there's no consumer surplus, and which is impacting their relevance, and their ability to raise prices in the future. So I agree. I think a lot of the growth numbers that we've seen from some of these companies have been driven by price more than volume.
Or shrinkflation.
Yeah,
Sneaky bastards.
yeah.
Yeah, CPG. Do you have any CPG companies? Do you have any insight into what's happening there?
I think it's just that. I think they have not pushed the value out further to make it enough consumer surplus to get people buying their products. I mean, if you think about laundry detergent, you go to Kirkland at Costco, what is the difference between the output from that versus Tide, right? Why would I pay an extra $2? Is it just the scent? Like what makes it so different that I'm willing to pay? And so, unless the consumer packaged goods companies can push that value proposition further, it's really hard to get those volumes back, because I think people would like to buy brands, but it's just the value is not clear. And we're all kind of doing these numbers in our head, maybe not explicitly, but we're thinking, why pay an extra $3 for Tide when I can get Kirkland and it does just as good of a job, right?
Probably came out of the same factory.
Right. And then Procter & Gamble may have made it. I have no idea if they do or not. But that's Costco's game typically, is to have the CPG or the OEM, so to say, make the Kirkland brand for them.
Yeah, I live in California, so all the detergent that I have doesn't clean the dishes. It just politely asks the grime to leave. It doesn't work at all.
You got that hippie soap? Is that what you're
Got the
doing?
hippie soap. Yeah. Doesn't kill anything. Doesn't clean anything. It's incredible. What about Copart? Do you want to talk Copart?
Yeah, Copart's been in a world of hurt. That's a name that I
It's
also
a
own.
darling too for so many years.
Yeah, great
Yeah,
business.
yeah. It is a great business, and talk about a moat. It definitely has one. A lot of the debate, a lot of the pullback has been on a couple of different factors. One is that IAA, their main competitor, was passed around like a hot potato between owners over the past 20 years. And so they were not a really effective competitor. So one of the things that's often brought up is Copart owns their land where they collect all the cars for salvage, whereas IAA typically rented their land or leased their land. So as prices went up, so did their costs. That's one factor. And so they were acquired by Ritchie Brothers. and now they're being integrated into Ritchie Brother auctioneers. And so apparently they've been picking up some market share now that they're under this new ownership. So that's been causing some concerns. But there's also broader concerns that you're seeing on the insurance side of things, where Copart's talked about how there are more underinsured drivers and uninsured drivers on the road, which is a pretty scary thing, to know that there's like 20% of the people out there driving are either underinsured or uninsured. And part of the pitch in the history was, hey, you have to have insurance, right? You have to be part of this network. So if your car gets wrecked, it goes through the insurance process, which is linked to Copart. But if 20% of the people are, only getting liability coverage and not collision coverage, right? Their car may not go into that insurance system in the first place. So there's been a couple different factors going in. It was also a little expensive anyway. It was trading, I think, 40 or 50 price earnings at its peak. So quite high. But today I'm looking at it and it's got $5 billion in cash. And the question is, what's management going to do with that $5 billion in cash? Could they do a Dutch tender? Could they make an acquisition? Where might they fit? So there's a lot of different things going on in the Copart world right now, but I like the setup. I think they've got a good management team with a long-term view. They've got these structural moats where if you are a big, large insurance company and you've got a lot of cars to process, you don't have a lot of choice. It's really Copart or IAA is your major way to get your damaged cars, get returns on them, right? So one of the things that Copart has going for it is they can take slightly damaged cars in the US. So let's say you're driving a new Mercedes and it gets rear-ended and it kills the sensors in the bumper, right? That may mean that the repair costs in the US are super high and it's not worth the insurance company writing the check. So they'll put it in their international market for auction, and someone, say in Eastern Europe, might buy it. They don't care about the sensor being broken. They just want to drive a brand new Mercedes. And so it's a way for Copart to get the insurance companies the best possible price. So talk about a moat that's really difficult to replicate if you were starting with, say, $10 billion. Really hard to match that business.
Why haven't they done a buyback so far? If they're what's the valuation? Where do you put the valuation?
I think the stock is cheap right now. I was surprised and a little disappointed that they didn't buy back material amount of stock this past quarter. I thought it was a great opportunity for them to do that. So that's been a puzzling thing to me. I followed the company for a long time and I think highly of management. So I'm giving them the benefit of the doubt on this one. But it is something that I am concerned about, that they haven't taken any substantial action. I mean, they've got more than half of their assets are cash right now. It's a very cash heavy balance sheet and it's not earning much. Put it to work. That's how I'm thinking about it.
Mm. Yeah, the founder's biography, The Junk into Gold, is also quite good. That's a fun book.
Yeah, the founding family and his son-in-law still own. It's not a huge amount of stock, but they own a material amount. So they're still owners of the stock. Maybe I think it's high single digits collectively, thereabouts now.
And I just realized, JT, we blew through the top of the hour. Veggies.
That's okay.
Sorry, team. 9 minutes past the hour. Market.
Served a little cold today. Is that what you're saying? All right. So there's this place in Edinburgh where the air just feels a little different. It's the kind of quiet that you only hear after something really big breaks. And this room that I was in was the Library of Mistakes. And I was in Scotland last week, and thankfully, Russell Napier was kind enough to arrange for the library to be open for me to come in for a private tour. And it's a really fun place to visit if you're a financial, history nut like I am. And it's wall-to-wall books covering basically every financial disaster that you can imagine. And when you step inside there, like the first sensation is humility, because just the quantum of books about disasters, it kind of hits you. Just this aftermath of every euphoria from the South Sea bubble, 1929 crash, LTCM, all these really large and almost surreal events that it's kind of hard to believe these mistakes were made by people that aren't so different from us. And so, it's kind of funny to me that every other high stakes profession tends to institutionalize its errors. Pilots will study crashes in simulators and improve their checklists. Surgeons meet every week to dissect the complications. engineering students will learn from collapsed bridges before they, design a new one. But in finance, we tend to just forget everything. Like it's very comfortable to forget. Forgetting allows us to believe that this time, finally, maybe we've reached some new paradigm. And the library of mistakes is really an antidote to that forgetting. It's a huge part of its power comes from actually where it sits in Edinburgh, a place where there's been incredible historical residents who live there that shape the way the world thinks. So, if you leave the library, you could walk 10 minutes in almost any direction and you'll find yourself in the intellectual neighborhood of giants, really. We can start with David Hume, and I took a picture with his statue when I was there. Hume was a philosopher whose central insight was that humans are creatures of habit and emotion long before they are creatures of reason. And he predicted behavioral finance basically before any 20th century economist. A short walk away from him lived his friend Adam Smith. Of course, people remember The Wealth of Nations, but really Smith's deeper wisdom probably sits in the theory of moral sentiments, which is a book about sympathy and pride and narrative and status. Then there's John Law, also another Scotsman, brilliant, dangerous, invented much of the modern central banking, and also engineered one of history's greatest economic collapses, the Mississippi bubble. Law's life is really kind of a reminder to us that like brilliance and catastrophe are almost cousins to each other. And if you want to know about how MMT would play out, there's probably already some spoiler alerts there from the Mississippi bubble. Not to editorialize. There's some other great Scottish thinkers like James Hutton, who was the father of modern geology, or J.C. Maxwell, whose equations they really unified these invisible forces that govern in the physical world of electricity, light, and magnetism. So when you connect all these ideas, the library of mistakes is really quite Scottish. It's a shrine to skepticism, humility, and reasoning. And so for the rest of the veggie segment, I'm going to try to attempt to provide a taxonomy of financial mistakes, breaking it up into 4 categories: emotional, ethical, structural, and then cognitive. So first up, emotional errors. And we'll start with the obvious, which are bubbles. They begin reasonable enough, usually a new technology, new demographic shift, a new land opens up, full of fresh resources. And then the story spreads, and then the optimism spreads even faster. And before long, the narrative becomes more powerful than any of the math. And tulips, railways, .coms, Japanese real estate, like each bubble really swells until the buyers end up exhausting themselves, and then gravity reasserts. And if they grow from narratives, these manias. So if we look at the other part of this, like bubbles grow from narratives, manias grow from identity, and there's a little distinction between the two. People buy because other people are buying, and they fear missing out more than they fear being wrong. So from Victorian railways to crypto tokens, probably to little monster toys in blind boxes that somehow trade for 4 or 5 figures today. That's the Labubus. These manias remind us that crowds are far from rational agents of economic textbooks. Next, we have ethical errors, starting with fraud. And they tend to flourish in warm climates. And I don't just mean Florida. Rising markets, loose oversight, high trust. So you have, Charles Ponzi, Bernie Madoff, Ken Lay, Elizabeth Holmes, Sam Bankman-Fried. Each is a variation kind of on the same strategy, which is promising big growth, shrinking evidence that that's actually happening, inflows replacing verification. It's all good until really the math stops cooperating. And then there's kind of this softer borderland between truth and deception, which is found in creative accounting. And that usually starts small as well. It's shifting a cost here or there, smoothing some revenue, adjusting metrics just this one time. And then once becomes policy, and then policy becomes culture, and rot creeps in. Enrod and WorldCom are kind of the headline acts of this, but there are countless smaller examples. And then third up are structural errors. And this is, leverage amplifying tiny, steady gains into something spectacular until, of course, these correlations shift by a few degrees and then the whole model snaps. So things like LTCM, Archegos, or however that's said.
No one knows.
What's that? Yeah, I don't know. No one knows. And this is really like cases where stability is actually kind of the red flag. And these mistakes, they really look harmless until suddenly they're very not harmless. And then lastly are cognitive errors. And this is from systems that tend to be too complex for us to really map. So think of like AAA rated, mortgage-backed securities in 2008. Like it's so complicated, CDO squared, maybe like crypto tokenomics that kind of collapse under their own opacity.
Crypto treasury businesses.
Crypto treasury businesses, maybe, yeah. And these aren't really necessarily failures of morality, but they're failures of comprehension. The system becomes more complex than the humans managing it can really keep up with. And I'm probably going to do a future veggie segment on AI funding being maybe the new shadow banking system, but we can put a pin in that for now. But when you're standing in the library of mistakes, you're surrounded by these centuries of like arrogance and ingenuity and collapse, and you realize kind of an awkward truth that's enshrined in these brick and mortar, and it's systems only evolve when they remember, and finance has a memory like a crackhead goldfish, really. But the library exists to lengthen that attention span, and one mistake, one story, one slightly less stupid cycle at a time. So I think it's actually a pretty noble aim that they have. So if you can't swing a trip to Edinburgh to check out the library of mistakes, you might consider taking an online course that they offer, which is it's a practical history of financial markets, and maybe even avoiding one mistake there would likely pay for the course many times over. So that's a little bit of a dispatch from the road. Bringing what I was goofing around with last week into a veggies.
Good one, JT. Let me do a quick shout out to all the people who are playing at home. Petah Tikva, Israel. I had instructions on how to say that, and I'm sorry, I've forgotten. I didn't do a very good job, I know, but I apologize. Dubai, Philly, Porto de Mos, Portugal, Toronto, Sam in there twice, Idaho, Santo Domingo, Valparaiso, Boise, Tallahassee, Lausanne, Switzerland, Oregon City, Oregon, Miami, Bethesda, Toronto twice. You guys should get together. Gothenburg, Sweden, Snohomish, Jupiter, Tampa, Breckenridge, Bremerton, Nashville, suburban Surbiton, Oslo, Sochi, Russia, Madeira Island, Portugal, Dead Cat Gully, New South Wales, me too, Ridgewood, New Jersey, Lawrence, Mysore, India. Good spread. There's a couple of good comments in here too. 60s with a high point in the States, so measuring from the 60s might be giving a misleading answer as to what's achievable today. Quality of living, maybe?
Oh, bullshit. I'll gladly take our modern world over 1960s, I think.
Me too. Can't switch from Gillette razors. I think that might be true. I'm kind of coming around to that view. I've tried a few and come back that they are all those extra razors. It really does. It's worth it. Torino, Italy, New York.
Toby, what are you shaving? Because it's not your face.
Touche. It's my throat.
Okay.
Keep it above the collar. Todd, let's go back to.
Can I ask a question of Todd?
Sure, please.
Todd, are you able to kind of reconcile, Buffett, and I know all the moats and everything that you've learned over the years, and with ESG? Is there a synthesis that can be done there that feels satisfying?
I think so.
I would love to hear the thoughts on that.
Yeah, and that's something that we talk about in my class quite a bit. We go through all of the sort of the ESG, here's how to kind of piece through that, and then think about, and the second part of the class, we do economic moat analysis and we do stewardship. And so thinking about from a moat perspective, it's thinking a lot about what the risks are to the company, what are the material risks that might break the moat, right? So thinking about, is there an environmental risk that the company has, or a social risk that has internal or external relationships? So looking at, say, a fast food company that has poor labor relations, right? What might that mean when labor gets the upper hand, like we saw during COVID, right? Wages had to go up. What does that do to margins? How does that impact the valuation? And so one of the things I've stressed is that ESG is not just trying to think about warm and fuzzy feelings. It's how can we figure out the impacts to the valuation? How does this impact cash flows, or how does it impact the discount rate? If we can figure out one of those two things, then we can start applying it to our work. What is the risk? What is the monetary risk that we see in different scenarios if they play out? And I also think generally thinking about companies that are focused on stakeholder analysis from the beginning. So companies that were thinking about how do I make sure that my employees are thriving and want to work here? How am I thinking about governance, making sure that I'm working for the shareholders and not just working for, the CEO, right? All these things kind of play and kind of come together, I think, with a Buffett like approach. So finding those stewards who are thinking about these things, like if they were talking about sustainability before it became a big hit in 2020, 2021, that's usually a sign that they take it pretty seriously. And I've found that companies that are serious about it and are hitting their goals and targets are generally doing that elsewhere as well. So if they're hitting their goals, hitting their targets, putting out measurable targets, they're not saying like, hey, we're going to be net zero in 2050. Maybe that's the goal, but here's how we're going to get there the next 3 years. Here's the steps we're going to take. They're not just making these big promises with no accountability, because as we know, the average CEO tenure is about 5 or 6 years, right? So they can make these long-term promises, but how are they going to make the case that they're getting things done towards that? So companies that can do that, I think, are worth looking at, because that means they're probably pretty efficient elsewhere in their business.
So that's kind of like a reverse cockroach in the kitchen.
Right, right. Yeah, it's interesting. I've done a lot of studies, a lot of research into different studies that talk about ESG risks. And one of the things was with governance. So it's not so much first decile, top decile governance is like a sign of outperformance.
What does that
Or
even mean, though? I mean, like measured how? Because you would
yeah,
like you show. I've seen Berkshire shows up poorly in some of these things, and it's like,
Or
right.
for
well,
lack of board independence or something.
yeah,
Yeah,
exactly. Like
yeah. So
somebody's checklist that they came up with. But
right.
it's kind of hard to see two guys that were more in tune with, their shareholders and the whole ecosystem than those two.
Right. It's very difficult to normalize everything. But what's interesting about this research was that it didn't really matter if you checked off all the boxes and you're in top tier, or if you're in the sixth tier. It was really avoiding the worst
Mm.
decile. That was where there was a clear signal of issues with performance. And
What do they
so
do? What do you see in that worst decile?
so these are some boards that are too small, boards that there's no separation of the CEO, chairman. There's not a lot of equity ownership in that group. I had an example from a previous role that I had where I was covering a company that had a huge governance crisis. Did an acquisition, stock fell, I think, 4 billion on the day for a $1 billion deal. Everybody
Do
just
not
had
approve.
everybody's had enough, and we're like, I'm out, I'm done. I've kind of gone along with this for long enough. But yeah, those are the situations that you want to avoid. And what that was one lesson to me was, there were even though everything seemed to be looking good business wise, there was a huge governance red flag, and that huge governance red flag should have been taken into bigger consideration, because once that bill comes due, and talking about the ESG class, we talk about off balance sheet liabilities,
Mm-hmm.
right? When are those coming due, and how much are they going to be? And that will have an impact on the valuation. So, really thinking about, avoiding, you're trying, like Charlie Munger talks about, you're right, avoiding stupid mistakes, right? Avoid those stupid mistakes, and good things tend to happen.
I think that's a good approach.
Yeah, I always like that saying that I think was it like the best internal like defense legal team on is a happy customer.
Right.
I got a good question from the crowd here. What do you think of the classic flyover industry mattresses? How come everybody missed the emergence of a major compounder there? I actually don't know what that's about. So,
I don't either. Yeah, I would say that what tends to happen, I think, with flyover companies in general, is that maybe they're not as well known on the coasts, right? There's
okay.
maybe a restaurant like Texas Roadhouse, for example, that
Mm.
just seems a bit kind of bizarre to someone in New York City. Why would anyone want to go to a place that's Texas themed on a Friday night if you're in Ohio? But there's like the Texas Roadhouse near my house, there's an additional parking lot for overflow. I mean, so those are situations where I think being in the Midwest gives me a different perspective than someone in a major city. Now, there's huge benefits of being in the major cities, don't get me wrong, but I think being in the Midwest gives you a different perspective on some of these industries that may not appeal or seem obvious to someone in Silicon Valley or New York City.
What's the story with Texas Roadhouse? Why does everybody love it so much?
So what's interesting about them, and I don't own them, but what I know about them is that they have sort of a decentralized model where the store restaurant manager gets a share, I think, of the gross profit. So the general
It's a good
managers
program.
at the stores, right, they're incentivized to they have their own P&L basically, and they get paid as a. And I think maybe the staff does as well. I don't know for sure, but that's one of the things I've seen that's really appealing about the business model. But apparently, it's got great food. I haven't been, but I've heard great things about it. Clearly, there's an overflow parking lot. Maybe I should
Yeah.
go to the one near me.
You're gonna have
I
to
was I
report
meant
back to us on that, Todd.
I meant
Yeah.
purely in terms of the food that they were serving.
Yeah.
That's what I was interested in. That
Yeah, I think
that
it's just like steak, potatoes, that kind of thing.
that Dutch Brothers used to have that same profit shared arrangement with their operators, but I don't think they do that anymore. Not since
Mm.
they went public, or they're scaling it back. JT, do you remember? Is it gone or is it just scaled back?
I don't know. I can't remember. I know at one time it was like that. They were franchise based and
That was a
very
hot stock for a
Chevron
while.
economics.
Where is that now?
Yeah, it's come
Is it
back
still
down to
is it still
earth.
hot?
It's not as hot.
Not as
I mean,
hot
the
as it
returns
used to
on
be.
capital of that were always just insane. Like you throw a little trailer up in a parking lot and then like just shove caffeine through it and
There's unlimited demand for caffeine, it
caffeine
turns
and
out.
sugar and fat
Yeah,
all at the same time. What a genius model.
yeah.
And Jake, I was going to ask you. I know we're running short on time, but with the mistakes of museum, that's kind of interesting. It's one thing I've really wrestled with myself is trying to figure out the balance between the proper amount of arrogance and humility
Mm,
and investing. Is you talk about some people say, hey, you got to be arrogant. Other people say you shouldn't be arrogant. Trying to find that line. And the best thing I've found is from the book Super Forecasters. Tetlock talks about intellectual humility, right?
mm.
It's not the same as self-doubt. It's taking into consideration like base rates and things where maybe I'm not making some exceptional bet here. I have to think about what the average company in this reference class has done. But that's even then, it can be difficult to outperform when you don't have that certain bravado that gives you a chance, so to say, to outperform, but also gives you the chance to crash and burn as well.
Yeah, there's an amazingly fine line between high conviction and arrogance, or even you know, discipline and stubbornness.
Right.
And I mean, it's just did it work out is probably the only answer of which one was it.
Right.
But yeah, I mean, I do think you can definitely do some things to kind of keep yourself intellectually honest along the way. Like you said, like understanding the base rates, probably like doing probabilistic predictions for yourself, and then seeing like if ideally going back and like understanding your Brier score, like how is your confidence versus your competence?
Mm.
It's very
That's
rare to
been a
see.
great way to underperform for about a decade.
Right.
Yeah,
Right.
yeah. Do all this work and then don't buy Nvidia and then just get smoked by everybody and their mom. But
I just like I just like statistical approaches for just clear out the things that have earnings manipulation or any sort of suggestion of earnings manipulation or any sort of
apparently bad governance also.
Mm.
fraud, any kind of I just and I put them all I lump them all together because I think where you get one, you get the others. Nobody's doing all of that, any of that stuff when they're doing really well. And it always clears out a few things that it's never anything. I don't find it clears out anything that I would be buying anyway, but it always makes me laugh at some of the names that pop up because they're often, popular names in the retail on Twitter. They're names that a lot of people hold.
Oh
And
yeah.
those scores are terrible. Yeah.
Speaking of that, I saw an update on Rick's. I don't know, did you guys see this? They
What
had an
they bought back that shareholder stock. That's crazy.
yeah, right before
The
the
ADW stock. Crazy.
CEO and the CFO apparently stepped down, but are keeping their same salaries and same vesting schedule.
From jail.
Well, who knows, but yeah, it seems like quite the governance mess at this point. Who would have thought that industry would have attracted somebody with, with maybe different scruples?
Right.
We joke. That's time. Todd, if folks want to follow along with what you're doing or get in touch with you, what's the best way to do that?
Sure. My RIA's website is kna-capital.com and my Substack is flyoverstocks.com.
JT, any final words?
Good question. No, not right now.
If you're interested in tracking that stuff, Journalytic is a great tool
It's true.
for
It's not
for
bad
doing
for
that. Keep you honest, keep you intellectually humble.
Absolutely. I agree with that.
Thanks, folks. We'll be back next week, same bat time, same bat channel.